In this video, I'm going to break down the full bear thesis for Palantir by outlining every major reason why you might not want to invest in the stock today. This is a follow-up to a video that I posted last week where I outlined the full bull case for Palantir. So I'm actually going to throw a link up here to that in case you want to see the other side of the coin as well. In that video, I also run through what Palantir actually does, what its products and services are, and what its use case might be. So if you're totally new to the company and to the stock, I actually recommend starting with the bull thesis and then coming and watching the bear thesis afterwards to get the full picture. Quick disclaimer before I get started, this is not intended to be financial advice and I'm not recommending buying or selling the stock. All I'm doing here is taking the publicly available information and putting it together in a concise way so that you can see both sides of the argument. Also, I do own some shares of Palantir, and like I said in the last video, always treat everything that you see on YouTube with skepticism and take everything that I say with a grain of salt. Now, with that out of the way, let's dive in. Let's start with the product or the service itself. Now, Palantir bears will say that it's too opaque and that Palantir is a black box.
I think it's too much of a black box to get a real read on the business. It's black box, we're not sure what they're doing. I wish we knew all the contracts because it's involved with the government, a lot of it's black box.
Palantir does not really offer free trials to people that aren't actual qualified leads to be potential big clients. And you can't really see how the product works really, aside from the demo day videos that they've put out, but obviously those are tightly controlled by the company's PR and their messaging team. There aren't a lot of public testimonials for the company, and so really it's difficult for journalists or analysts to get a sense of whether or not the product is actually as good as the Palantir executives and management team say that it is. And so I think this is a bit of a fair criticism that all around Palantir is kind of shrouded in mystery, and it is difficult to understand how the products and services work if you don't have access to it. For the second bear argument, let's talk about potential controversy, because there's a bunch of issues that I'm going to lump together here, including privacy concerns, data security issues, and the types of contracts that Palantir sometimes signs can lead to reputational risks for the company. On the first point, since Palantir's software is aggregating and analyzing so much data in sometimes sensitive areas, including healthcare and the financial sector, then there are potential concerns about what might happen if there was a breach. In the UK, for example, there have been some concerns from the general public and from lawmakers about Palantir's access to healthcare records, so this is something that could arise in the future. Data security is another potential point for controversy because obviously with access to some sensitive data, if Palantir was ever to have a security breach, then that could be potentially devastating. And there was a recent story where some people had access to secret FBI files that were not supposed to have access to it. This just happened in August 2021. Now, luckily, none of the data got into bad people's hands, but essentially the wrong workers had access to data that they shouldn't. It wasn't properly compartmentalized. And obviously, when you're dealing with national security, there's a very low threshold of acceptance for this type of security breach. So if there were to be more issues, that could be a potential huge problem for Palantir and then obviously for the stock as well. Finally, there's a potential issue around the types of clients that Palantir works with. And a good example is when they signed a contract to work with the deportation program run by ICE in the US. A few years ago, it was discovered that Palantir was providing data analytics software to ICE to help them with their deportation program. And this is when children were being separated from families and put in cages, and there was this whole big thing in the news, and obviously Palantir got a lot of bad press. As a result of those human rights concerns, over 200 Palantir employees wrote a letter to the CEO, Alex Karp, asking that something be done. Amnesty International released a report with a scathing indictment of what Palantir was doing. And all of this just hammers home the fact that if Palantir signs up a big client that's doing something that the general public does not like, then it comes with some pretty big reputational risks for the company. And Palantir cannot afford to risk alienating its employees, the general public, lawmakers, or potential clients. So this is something to keep an eye on because obviously it could be a huge flashpoint in the future. Of course, all of these issues are compounded by the fact that Palantir does a lot of things secretly or it doesn't disclose them publicly, which makes it very difficult to have an effective PR campaign because obviously you can't really talk about the work that you're doing if you signed an NDA or if you're working with secret material. Okay, Okay, let's move to the next bear argument against Palantir, which is that it's not scalable. And this is one of the go-to arguments of Palantir bears. They say that essentially it's a glorified consultancy, it's not a SaaS company, and it cannot scale its business. First of all, it's just expensive for Palantir to sign on new clients. They have to spend a lot of time, money, and resources, especially human resources, to get new people on board, which is a huge risk for sure, because if you can't sign on customers quickly, then you're not able to scale as quickly, and that could be a big hit to the bottom line. It has also historically taken Palantir a long time to sign up new customers, although we have seen with Apollo, they are able to actually deploy their software much faster, but that doesn't account for all of the lead generation time and then actually going through the sales process until you actually finally ink a deal on the dotted line. Also, for serious large-scale products, Palantir sends forward deployed engineers out to meet with the clients and set up the actual systems, which is of course a huge cost and takes a lot of time. Not only does that make it difficult to scale the business because you're hampered by the number of forward deployed engineers that you have, it also means that your labor costs are going to scale with your revenue because you're going to have to spend more money to make more money. In recent filing, Palantir actually acknowledged this, saying that our sales efforts involve considerable time and expense, and our sales cycle is often long and unpredictable. Next, let's talk government. And in the bull case, I said that being close to the government was actually a positive because it meant that Palantir was more recession-proof and it had a lot of sticky clients that they wouldn't be able to get rid of easily. But on the flip side of that, bears will say that Palantir is too close to the government, that it's got way too many government clients, and that if anything was ever to happen to jeopardize that relationship, it would impact the bottom line immensely. As of the last earnings call, Palantir had over 50% of its revenue coming from the government side of its business, which is a risk because if they can't diversify that and scale up the commercial side quickly enough, then that could be really too lopsided. It was okay when they were just starting out because that's basically what the company was designed to do. But now that they've gone public and they've set these lofty growth goals for the next 5 years, they really need to decrease their reliance on government contracts. And this relates to the next point, which is about customer concentration. Currently, a huge percentage of Palantir's total revenues come from a very small handful of clients. In total, they only have 169 clients as of the Q2 filings. That puts their average revenue per client at 7.9 million. However, if you look at the top 20 clients, they account for 39 million each, or over 780 million per year, which is obviously a massive chunk of Palantir's total business because in the trailing 12 months, they only made 1.3 billion. That is obviously risk. Even just the loss of a couple big ticket clients could be a huge hit to Palantir's revenue. Next up, let's talk leadership. Now, you won't find a lot of bear arguments about Palantir's leadership because Peter Thiel is legendary and Alex Karp has somewhat of a cult following as well. However, there are some people that say that since Thiel and Karp aren't actually specialized in the area that the business operates in, it could be a potential downside. Thiel and Karp studied law and philosophy respectively, so there are some people that have made the argument since there isn't as much sector-specific expertise amongst the top brass, then it could hurt the company. Now, I'm not sure if I actually buy it, and I think there's way more pro arguments on the leadership side than there are con arguments, but I'm giving you the whole picture. Okay, stock-based compensation. And this is another point that Palantir bears like to hit a lot because they'll say that the stock-based compensation for the company's executives in particular is excessive. And in fact, it is pretty high. Over the past 12 months, there's been over $1.4 billion in stock-based compensation. And a lot of that is going to the top brass, including Alex Karp. This could potentially be an issue because A, the fact that the stock-based compensation is so high maybe reflects the fact that Palantir has some issues cash managing and can't actually afford to pay its employees what they're actually worth on the open market, so they have to give them equity instead. B, having such a huge amount of stock-based compensation dilutes the shareholdings of everybody else, including potentially you and me. Now, on the equity point, there's a pretty solid counter-argument because Peter Thiel is actively known to say that he likes giving people equity in the startup because it gets them to stay loyal and it makes them actually buy in and work harder. On the shareholder dilution side of the argument, there isn't much of a counter because it is true that when you issue over $1.4 billion worth of new shares in a 12-month period, of course, there's going to be some effect. The last thing to say about stock-based compensation is that it's prevented Palantir from being a profitable company up till now, but obviously that might change in the future, and I'm going to talk about that a little bit more later on when I get to the numbers. Another red flag that's related to the stock-based compensation is the issue of insider selling of shares. So all of these new shares have been issued, a lot of them to the executives like Karp, and a lot of those executives are now going and selling those shares. In the past couple of months, over $250 million of shares have been sold by insiders. And what's worse, a lot of that has been from the CEO, Alex Karp. And so this raises a question: do Alex Karp and the rest of the board of directors actually believe in the future of the company? Of course, Alex Karp is going to say that it's routine, and really there's no way for us to know what his motivations for selling are. But there's a couple of reasons why he and other members of the executive team might be selling so many shares. First of all, executives with the company have been waiting a very long time to get a payday, and since the company recently IPO'd, they're finally cashing in, which is obviously a reasonable expectation that when the company goes public, you might want to sell some of your shares, buy a nice house, buy a nice car, whatever. The second potential explanation is that when their stock options are exercised, there's then a tax bill that becomes due. And in order to pay the tax bill, if they don't have a lot of cash sitting around in their personal accounts, then they're forced to sell some of their shares in order to pay the tax bill. Really though, there's no definitive way to answer this question. Is it a real red flag, or is it just kind of routine business and these executives are just cashing in a little bit on a lot of their hard work? Next up, let's talk about employees. And some Palantir bears have suggested that there could be a risk to the company because Palantir employees aren't necessarily paid as much as some of their counterparts might be in other Silicon Valley or tech companies in general. If you look at some statistics, including on Glassdoor, you can see that Palantir is not among the top payers for engineers, software engineers, or AI engineers, but they do have a pretty competitive stock-based compensation package. Now, this is another one of those bear arguments that I'm not so sure if I believe, but there you have it, and it could potentially be a risk because if a lot of the key employees decide that they want to jump ship and go work at Google or Facebook or whatever where they can make more money, then obviously that could hurt Palantir. Total addressable market, or TAM, is really one of the key points to highlight here because whether or not you believe it's a large TAM or a small TAM is going to determine what you want to do with the company. On the bull side, people say that Palantir's TAM is infinite. It can just go work in any sector, any industry, and it could have a huge potential market. On the bear side, however, people say the exact opposite. First of all, just because Palantir might technically have the ability to go and work with clients in every sector does not mean that it's actually going to be able to do that. Even though there's a huge amount of data and a lot of companies that Palantir software could potentially help in significant ways, it does not mean that those companies are going to want to work with Palantir or are going to be able to afford to work with Palantir. And that last point is really something to keep in mind. Obviously, Palantir is not cheap. So while technically there's limitless numbers of clients that could potentially benefit from Palantir software, there's very few clients that are actually going to be able to use it. And for these reasons, there are some Palantir bears that say the total addressable market is small, that it's more of a niche consultancy, and that it's not going to have as widespread of an impact as it thinks it will. Next up is competition. Now, like I said already in the bull case video, Alex Karp, the CEO, says that he believes their biggest competition comes from potential clients developing their own in-house solutions. Setting that aside though, let's examine whether or not there's actually other companies out there that could do what Palantir is doing. And while the Palantir bulls will say that it's in a league of its own and there's nobody else that can do what it's doing, the fact of the matter is there's a lot of other companies that work in data analytics and AI and enterprise resource management that could solve some of the same problems that Palantir is trying to solve, albeit potentially not in exactly the same way. So what are those companies and how strong is that competition? First of all, there's the Salesforce Tableau software, which might be Palantir's biggest competitor. And really what it does is it helps make sense of a huge pile of data in order for businesses to make the best decisions. So sounds a lot like what Palantir does. Other potential competitors include Adobe Analytics, which they say helps their customers create a holistic view of their business by turning consumer interactions into actionable insights. And then you've got Twilio, which is supposed to take data that's siloed in different systems and then help a company put it all together and use it. You've got Google Analytics, which has a lot of tools that are actually totally free that can help small businesses make sense of all their data and to have it ready to go in useful ways. So yes, there are other companies that do data analytics work, that do enterprise resource management work, and Palantir is not entirely in a league of its own. Now, I'm not here to make a pronouncement on whether or not any of the potential competitors are actually going to best Palantir or if Palantir is going to emerge as the winner in the space that it's trying to operate in. But the point is, it's not necessarily the case that it has a total monopoly on the market. Next, let's talk ownership. And this is an interesting point because aside from the fact that Cathie Wood is a vocal investor in Palantir, there is not a lot of big money or smart money that's invested in the company. Now, normally with a company that's worth $50+ billion, institutional investors are going to account for most of that money. But in the case of Palantir, it's actually the opposite. The proportions change on a regular basis, but as of the most recent data that I have, over 60% of the company is actually owned by retail investors. And why might this be a bad thing? Well, the reason is that most of the time, institutional investors adopt more of a long-term approach to investing, whereas retail investors are more likely to react to news and to negative catalysts, so buy and sell all the time. It's not necessarily all bad though, because if there's a move from more institutional investors to get into the company, then that could actually be a positive catalyst for the stock. So we'll see what happens. Related to the issue of ownership is the issue of control. And Palantir is structured in a really weird, unorthodox way where they have many different classes of shares, but there's one class in particular, the Class F shares, that has almost exclusive control over the company, where the founders are basically going to be able to guarantee that they make the decisions about what happens, and regular investors, retail investors, aren't going to have much of a say at all. And because retail investors that hold Class A shares of the company aren't going to have much of a say in what happens, the issue comes down to, do you actually trust the management to execute on what it says it's going to do? Because if you don't, then yeah, that could be a big issue. Now on the bull side of this, people will say that it doesn't matter because Karp and Thiel are visionary geniuses and there's nowhere that the stock could go but to the moon.
Houston now controlling.
But on the bear side, if you get into a situation where a lot of the investors don't agree with the direction that the company is going in, it doesn't really matter because you don't get a say. Another related point is that having all those Class F shares with that weird ownership structure means that it could be difficult for Palantir to be listed on the S&P 500. And the reason for that is that there's sort of corporate governance regulations and rules that a company needs to actually abide by. And in Palantir's case, with these Class F shares, it doesn't currently meet those. This is something to keep in mind for the future because generally speaking, being listed on the S&P 500 is a benefit to a company. And that's because when a company is listed on the index, all of the index funds that track it have to then go and buy shares in that company. And so that could potentially put upward pressure on the stock, at least in the short term, but it's also going to make it much more stable because it's not going to be liable to huge volatility when there's some tiny piece of negative news, because all of these institutions that hold money in it because they're tracking the index are not going to buy and sell regardless. Next, let's talk about the fact that Palantir is considered by some to be a meme stock with a lot of hype around it. So let's look at the facts. Palantir is one of the top 20 most held stocks on the Robinhood app, and it's also frequently discussed on the Reddit/Wall Street Bets forum. And like I already said, institutional investors only own a small amount of the company, and it's really retail investors that have bought up a significant amount of the Class A shares. So of course, there's some well-educated, serious analysts that see this as a potential bubble because all of the hype around it means that the price of the stock could potentially be inflated, and if that bubble ever bursts, then everyone will be left holding the bag. And there definitely is a lot of hype around the stock. If you look on YouTube, you'll find a ton of videos talking about how it's going to have a $1 trillion valuation in just a couple of years, which is obviously an outlandish claim because there's only a small handful of companies that have ever actually reached that type of market cap. Now that said, Palantir is not on the same level as GameStop or AMC, and I think that its actual underlying fundamental business proposition is much better and much more future-proof. So whether or not you believe all of this about it being a meme stock and then all the hype potentially creating a bubble is up to you. But nevertheless, it is definitely something that Palantir bears like to talk about. Next up, let's talk about SPACs, or special purpose acquisition companies, but from the negative side this time. Now, in the bull case video, I said that by going out and investing in all of these SPACs, Palantir is creating a pipeline for future potential clients, and it's also creating access to new streams of data that it can use to train its AI. But on the bear side of the argument, essentially what it boils down to is that some people think that investing in these SPACs is a way of buying revenue and that it's an accounting trick to erase some of the profitability issues that Palantir has experienced. And for one final qualitative argument, I'm gonna throw this out there, but really I don't truly believe it. But I have seen some people saying that Palantir is in a sector that could experience a decline. And so if that were to happen, then that could pose a risk to the company and to the price of the stock. Now, the reason why I don't worry too much about this is because you could say the exact same thing about pretty much every single company in every single industry. Of course, if there's a sector-wide downturn or even an economy-wide downturn, then the company is going to suffer. But that doesn't mean that it's not a buy, and it doesn't mean that it's not a solid company that has solid growth potential for the future. And if anything, I think there's tons of other sectors that are much less future-proof than Palantir's sector in the data analytics and the AI space. So I don't lend too much credence to that. Okay, let's talk numbers and let's start with revenue, especially the growth projections that Palantir is making, which some analysts say is very lofty. Palantir is projecting to hit a 30% growth in top-line revenues per year for the next 5 years. But some analysts will look at that and say it's probably not going to happen. They'll say that if Palantir wants to actually hit those targets, it needs to radically alter its sales strategy and its marketing strategy, and that there's a huge amount of risk to the price of the stock because they say that the valuation of the company is predicated upon that assumption of growth. And if it doesn't occur, then obviously things are not going to go well. If there's new competition coming in as well from companies like Salesforce and Amazon and Google, then that could eat into Palantir's market share and decrease its growth rates. Another potential issue is that as Palantir transitions from only working with the government to being joint government and commercial enterprise, if that transition is not managed well, it could affect revenue growth. Of course, after revenue growth, what's next but profitability? And in the 17 plus years that Palantir has operated, it has never once actually turned a bottom line profit. It took Google only 3 years to be profitable, and it took Amazon only 7 years. So what's the deal? If we look at the last year, there was an operating loss of over $1 billion. Now, granted, a lot of that was because of that stock-based compensation, but even if we look at the adjusted operating income for the last year, that's still negative almost $200 million. If this trend continues and Palantir doesn't find a way to balance growth, but eventually turning towards profitability, then that's going to be an issue. An interesting metric here is something called the Rule of 40, which says that growth plus the profit margin should be over 40%. And according to that metric, Palantir is not performing well at all. Turning now to valuation, a lot of Palantir bears will just say, simply put, the company is overvalued at its current prices. And if we look at the price to sales ratio, which is currently 40, or the forward PE ratio, which is currently 130, both of those metrics are just much higher than a lot of the others in the industry. And so they'll say that even if you like the company's product or service or its mission statement, it just doesn't make sense based on the current valuation. And so that is more or less it. Those are the major bear arguments against investing in Palantir from both a qualitative side of things as well as from the quantitative side of things, looking at the growth and the profitability and the valuation of the company. Now, I'm thinking about making a much shorter video just comparing some of the key points from both the bull and the bear side of this to see which has a stronger argument. So let me know if that's something that you're interested in seeing. Otherwise, I really appreciate you watching this far. I hope you enjoyed it and found it helpful. And if you did, please don't forget to drop a like down below and subscribe to the channel. And I will see you next time.